In this video, I'll discuss the business model and Q4 FY25 result of Thomas Scott. So, Thomas Scott is a traditional apparel manufacturer and retailer. They are present in both B2B and B2C segment. In their B2B segment, they have 4 manufacturing plants, 2 in Maharashtra, 1 in Bangalore and 1 in NCR. They do contract manufacturing for Raymond and Red Tape, and one thing is very good with Thomas Scott is they have a unique data analytics system by which they analyze the trends on the online platforms like Flipkart, Amazon, Ajio, and by analyzing those trends they manufacture their product accordingly. Okay, so that is a really good thing that they are leveraging technology with their manufacturing capacity. So that is the thing with Thomas Scott, really good thing that they are leveraging the technology. So that is the thing. And in their B2C segment, they are present in Flipkart, Amazon, Ajio, Myntra. Okay, they are present in the online platforms, and they also have 5 stores in Bangalore. So in terms of B2C also they are expanding very fast. If we see their B2C revenue contribution in 2022, they contribute like 5% to their whole revenue, but in 2025 they contributed around 95%. So B2C becoming the main thing with Thomas Scott, and that is really a good thing if a company is transforming from B2B to B2C, and if they can grow it faster. So that is a really good thing. And another thing is that they are present in online, mainly present in online. Then they have also 5 stores in offline in Bangalore. But the thing is that there is a huge potential in the online platforms in the future. So that is a good thing. If they can grow, if they can provide good products to their customer, they can do very well. And they are mainly present in the mid range segment. They are mainly selling prices around from 1000 to 3000 kind of range. So that is their point. So let's talk about the Q4 FY25 result. So in the Q4 FY25 they grew their revenue by 85%. Okay, and they are consistently growing their revenue by more than 50% for last 4 years. If we see from FY22, 23, 24, 25, all of these years they have grew their revenue by 50%. So that is also a good thing that they are growing their revenue at a fast pace. In Q3 also they grew their revenue by 110%. So that is a really good growth in terms of the revenue. And if I talk about the B2C segment, B2C segment grew around 100% in this FY25. So that is also a good thing. Their B2B segment gone down by 30% in this year. So yeah, they are bringing down the contribution, bringing down the revenue in B2B segment. They are more willing to do the B2C segment. So that is a good thing again. Okay, because in B2C segment the margins are bigger. If you see, because you are a manufacturer and you are a seller, then the margin always becomes really big. So that is the thing with Thomas Scott. As I said also that in 2022 B2C segment contributed around 5%, but in 2025 B2C segment contributed around 95%. So yeah, that is a really good thing. In terms of margins also, gross margin improved by 650 bps in this quarter. So yeah, always, as I said also in the last part, that if you can grow their B2C segment, then always the margin will be higher. So gross profit margin is at 40% in this quarter, and last quarter also it was 50%. But yeah, quarter on quarter there is a drop because of maybe the seasonality, that Q3 was like always for fashion companies is bigger. Okay, so that can be a point, but yeah, their gross margin is around 40 to 50%. So that is a thing. And year on year they improved by 650 bps, so that is a really good kind of improvement. In terms of EBITDA margin, in the last few quarters always they have been in the range of 10 to 14%. So that is a thing, good thing for if I see they maintaining their EBITDA margin in a range. So that is a thing. If they can grow their EBITDA margin in the future, that would be really good. So that is the thing. In terms of their PAT, they grew their PAT by 4% year on year. And if I talk about the PAT, because I think it is because of the, like, there is a accounting thing that they were in loss in last few years. So in the last year FY24 they may get some rebate on their profits, okay, on their tax. So the tax may be lesser in the last year. That can be a reason, because last year there was no tax, they did not pay any tax, but in this year they paid their tax. So that is the reason, I think that is why the PAT is lower. If I say the PBT grew by 58% in FY25, which is a really good kind of growth in terms of the PBT. And in this quarter they grew their PAT by 42%. Okay, yes, they are not getting the operating leverage, yes, because their sales are growing about 100%, like 70-80%. Okay, so here they are not getting the operating leverage, but that can be a reason, because you have to expand. Okay, you always have to expand, and there is some expenditure because their depreciation is also increased by a good margin in this year. So that can be a case. But anyway, the sales are growing at a fast pace of like 50 to 100% kind of growth they are having in the last few years. So that is really a good thing. And if they can increase their B2C segment more and more, and if they can grow at a similar pace for next few years, and also they have the chance, okay, because online is a huge market and have a huge potential in the future also. So that is the thing. We have to track it every quarter, that how the numbers are going. So that is the thing. In terms of the valuations, they are trading around 50x PE. So in terms of PE also, I think it is on the par if we see, because I am not I am like in my view 50x PE is not overvalued nor also fair. I think it is undervalued in terms of the PE, because they are growing about 50%, and they are becoming a B2C player from B2B player. That is also a really important point, that always if we see B2B player always valued at lower versus a B2C player. So that is a thing, that they are transforming from a B2B player to B2C player. That is why there is a huge chance that their PE may got created in the future also. So let's see what happens in terms of the valuations. But in my view, that is undervalued. Absolutely, I can say it, because they are growing about 50, 60, 70%, and their PE is at 50%, 50x, sorry. So that is the thing with the valuations. So let's see what happens. So that's it for the video. Thanks for watching.